Hey, thanks for joining us today on This Sea Ranch Life. Today, I've got as my co-host Maureen Simons. Some of you may remember Maureen from past episodes of This Sea Ranch Life. Maureen is, in her own way, qualified to talk about this topic. Today, we're going to cover what I guess is really a crisis in homeowners insurance, and it has been made even more critical because of wildfires and climate change. Also joining us is Amy Bach. Amy is the executive director of United Policyholders, which is a consumer advocacy group who is dealing with and lobbying and advocating in the whole area of homeowners insurance and what that means for us. Thanks to both of you for joining you. Maureen, as a wildfire survivor yourself, you bring a special perspective, and I think you're highly qualified to talk with Amy about this.
Thank you, George. And hi, Amy. I guess the reason I'm qualified is because my husband and I lost our home in the 2017 Tubbs fire in Santa Rosa. We live part-time in Sea Ranch and part-time there. I met Amy eventually, and I heard about United Policyholders after the fire when we were dealing with a devastating loss of everything. And found them at a recovery resilience center that the county had set up that was full of all sorts of fascinating things to do, like filing for FEMA payments and getting your passport, your birth certificate, and everything else reissued so you'd have an identity. But the most impactful thing that actually happened the day I wandered into that building was I happened upon a couple of tables full of volunteers and employees of United Policyholders, and discovered there was this amazing nonprofit consumer advocacy group that was there to help survivors and victims of whatever you want to call it, of wildfires or other insurance-based disasters, both in terms of how to navigate that labyrinth, but also I learned they do a tremendous amount of advocacy on insurance policy, rates, legislation, et cetera. And so they literally became an enormous help and guide for us as we wandered that labyrinth. And I was, in fact, so impressed with the quality of the people and how much they helped and supported us that I ended up joining the board. So if that's my qualification, I'm just so grateful to have met Amy and know the entire crew at UP. So Amy, welcome.
Thank you. It's a pleasure to be helpful to your neighbors.
Yeah. So the crisis in homeowners insurance and disaster relief is not just a California issue. It's not just a wildfire issue. It's a broad-based issue across the country. Why don't you start by telling us a little bit about the scope of the problem? Because we see it very locally and lots of people are experiencing cancellation of policies, outrageous rates, et cetera. But tell us about the big picture scope of the issue.
So, you mentioned that after you lost your home and you were gathering information, one of the things that you were looking at was what kind of government aid would be available to your household. But of course, for most people, their private insurance is in fact the source of the money that covers repairs and rebuilding. Government aid is important. It's helpful. SBA loans. If you're low income, you can get a modest amount of money from FEMA. But for the vast majority of homeowners, private insurance is what delivers the dollars to put you back where you were as close as possible before the tragedy. And normally we don't think about it. It's one of those bills that comes due and you pay it, and most people hold their nose when they pay it because, hey, you can't enjoy insurance, drive it, eat it. It just feels to a lot of people like just money I have to pay that doesn't ever seem to really bring me back anything. But if you have gone through a major loss, you know what an incredible difference it will make if your insurance company steps up, pays up, right? So the whole crisis that we're going through right now is because we are all, as property owners and even renters and businesses, pretty dependent on an industry that is not the government. It is a private industry. And so what we have been going through with the property insurance availability and affordability crisis is a recognition that the financial health of people's households is heavily tied to decisions made by a private sector ecosystem. And what we're seeing is that insurance companies do tend to have a bit of a herd mentality. One of them does something, and then the next thing you know, the other ones are acting similarly, right? So here you have something where people had not really been having to think about insurance. It was just, okay, maybe it's 800 or 1,000, or maybe if you have a higher end home or an unusual home, you've been paying 5, 6, 7, 8,000, or maybe you have you're that cautious person who has earthquake insurance. Maybe you're up around 10,000 a year, but for most people, they've been paying in the neighborhood of 1,000, maybe 2,000 a year. And then starting about 6 years ago, that started to change, and it just started to change faster and faster. And what started as a regional crisis in the foothills of the Sierras, which we thought originally when it started, the year before your fire, the year before the Tubbs and Atlas fire, so 2016, the news reports came out that there were over 100 million dead trees along the spine of the Sierra mountain range, and people in the foothills community started getting dropped, even though there hadn't been any fires. And so our first understanding of why are insurance companies dropping people in areas that haven't burned, because we had seen, after the Oakland fire, when my organization, that sort of when we started, we had a big patch of people getting dropped the year after that fire. And at the time we were like, why would an insurance company drop people in this area? It's already burned. That I don't understand that. We came to understand that a lot of that was just a business decision made by, executives see the red ink. Oh my God, look at all that money we paid out in that region. We better move, we better, reduce our market share there, that kind of thing. So we understood it to be a business decision. We understood it to have a connection to climate change, the perception that, okay, with drought conditions, we're going to see more wildfires, right? And then, of course, then we had 2017, and then we had, all the fires in your area, followed by, the Kincaid fire and the Glass fire, and then the Camp fire the next year in Paradise. And then we had the Thomas fire in Ventura around the same time. And so it kind of was like, if experts were thinking that those dead trees were a harbinger of increased risk associated with climate change, that whole series of very record-breaking destructive fires proved them right? So risk is higher. What I have now come to understand is that it's not just risk is higher. There's a very big tech-driven element to what's happening, with a tinge of inflation thrown in, and a little bit of politics, but more importantly, now that insurance companies have the technological tools to get a much more vivid picture of the condition of your home and your neighbors' homes and your community from the sky, from the data they now can buy
via drones.
It just looks much riskier to them. So there's that human element of the executives going, whoa, I don't know if we're going to make as much money here, because we're going to get more claims, and claims cost us money. We better charge more. We've got a perfect storm combined with another phenomenon driven by what's called the reinsurance sector, which is the companies that insure insurance companies.
Can you tell us a little bit more about the use of technology? Because the various things I've read and I've heard, certainly from other people, is the use of drone technology and artificial intelligence has been driving somewhat arbitrary decisions. In my own neighborhood, where we rebuilt in Santa Rosa, we had people that literally live next door to each other, or, like a few hundred yards away, who one was dropped, one got to, keep their insurance. And both had done a lot of home hardening. You rebuild in a fire zone, you obviously are going to build the
Sure.
most fire resistant structure you possibly can. What can consumers do if they suddenly get a notice that they're not going to be renewed, and yet they aren't necessarily on paper even a huge risk? I mean, we've had people that live right on the bluff of the ocean here in Sea Ranch with few trees right around them get canceled. So
Yep.
what can consumers do?
So the first thing you can do, you can go to our website. It's free. We are as pure as you're going to find a source of insurance guidance, because we don't sell insurance. We don't take money from insurance companies, but we spend all day, every day trying to understand the marketplace and giving people guidance. So we have tips. What do you do if you've been dropped? We have tips on is it safe to insure my home with a brand I've never heard of? What kind of homework do I need to do to figure out if this insurance company is going to have enough money to pay claims in the event of disaster? So lots of free shopping help at our website. So that's number one. Number two is finding a good agent is one of the best things you can do for yourself today. And there's a lot of reasons for that. One is that with a lot of the brand name players on the sidelines right now, right? A lot of the brand name players, State Farm, Farmers, hit pause last year on selling new policies. We haven't had as much as we would have hoped in terms of competitors picking up those policies, which normally that's a really important consumer protection, is competition, right? They want your business. And then if one, State Farm, I mean, they have a fifth of the market in California. So 1 out of every 5 homes in the state is insured with that one company. So they have a tremendous amount of market power. So
I'm sorry, what was that company?
They have a tremendous amount of market power, right? So whatever their decisions are, it's going to have a big impact, right?
I'm sorry, what company was that though?
State Farm.
State Farm. That's what I thought. Okay, just want to be sure.
So normally as a consumer advocate, we would always say, well, hey, there's life after, the State Farm drops you, because there's other companies out there. You just didn't know about them because you've been dealing with the State Farm agent your whole life. You didn't know, where else to go. So traditionally we would say, hey, you know what? Competition is better. We want there to be more companies. If you get non-renewed, you shop and compare, you'll be okay. Today, it's much harder to shop and compare. We have not seen the kind of competition filling in the void. And part of that is the technology that insurers are now using that makes everybody look much riskier than they did when they were just thinking about us on, as an abstract address, right? But now that they can see all the trees and the mapping and all that. But also there's some politics afoot. I think, in general, insurers have been a little bit on a political mission to make some changes here in California. So I think that's part of what's going on. But yeah, I mean, some of the non-renewals, they don't make sense. And a lot of it is this AI driven decision making. You're in a zip code, or you have an older home, or they think you have galvanized plumbing, or you have knob and tube wiring. Those are all things that now insurers are calibrated to be on high alert for. So, and yes, some people for sure have been forced into the FAIR plan of last resort, and they really don't belong there. They are a decent risk. It's just that there's all these other things happening, and maybe, the household didn't quite know where to go. They went to their same agent. Their agent only had one option for them, and they weren't going to bail on their agent. So they went with the option that the agent gave them.
Can you clarify the difference between an agent and a broker?
Yes. So an agent is going to can only generally it's a captive agent. So that would be an insurance salesperson that can only put you to one company or maybe two. So traditionally, I don't want to pick on State Farm, but they are captive agents. They can only sell you a State Farm policy. Same with Farmers, same with CSAA, same with AAA, same with USA. But then there's this whole other category of a broker that can put you with any one of a number of companies. So that would be, if you go to an independent agent, they could put you with the Hartford traditionally, they could put you with Safeco, Chubb, etc. That would be your broker. So more choices with a broker, fewer choices with an agent.
Okay. And how do people find brokers?
So they will advertise as an independent agent. They call themselves independent agents,
Okay.
or brokers, right? So if you go on their website and you see some of these brands that I mentioned, Hartford, Safeco, Progressive, Mercury, they sell through brokers as opposed to these other companies that sell through their captive agents. Now,
Okay.
there's one little wrinkle here, Maureen, as if this weren't complicated enough. Because a lot of the captive agents have been starving, right? They don't have any place to put their clients. Some of the Farmers, Allstate, have started to let their agents go a little bit outside and sell their products if they're available. Also, you know, or something called a non-admitted type of a product. So there are these there's different kinds of insurance companies. There are the admitted ones, fully licensed, regulated, protected by the insolvency fund, have to participate in the FAIR plan. Those are the brand names most people know. But then there's this other kind of insurance company that is picking up more and more homes and businesses in California that's called a non-admitted or excess or surplus lines. The most famous one of those brands that a lot of people would know is Lloyd's of London.
So they're not backed up by the insolvency.
No, so they're not backed up by the what's called the CIGA, the California Insurance Guarantee Fund. Now, this isn't as big a concern as you might think, right? I mean, in all the years I've been working in California, which is a lot, I've only seen one homeowners insurance company have to go there, and that was after the Camp Fire in Paradise. One smaller insurer, Merced Property Casualty, had, I think, like 95 homes destroyed, and it was too much for them. They could, in one area, and they couldn't cover all those claims, so they went insolvent. But it's not going to be that big a deal. As more and more people are going with those companies, they're like, well, if it's between the FAIR plan and this company that's non-admitted, if my agent tells me this non-admitted company is strong, I guess I'll go there, right?
Okay. Non-admitted to the insolvency.
Right. Not
Okay.
admitted, meaning
The way to remember that.
not as regulated.
Okay.
Their
Yeah.
forms, their products, their rates, they're a little bit, they were, then they are still supposed to be specialty insurers for things like boiler and machinery and, odd risks that normal insurance companies didn't feel comfortable taking would go into these surplus lines. But now a lot of people are going into them because out of desperation.
Okay. Let's talk a little bit more about the FAIR plan. I think there's a lot of confusion over what that is. It's a sort of different perceptions that it's somehow funded by the state of California, which I know it's not, but a lot of people kind of assume that it's some sort of a backup plan that California has. Tell us more about the FAIR plan and at what point it makes sense to investigate that.
Sure. So the FAIR plan is what's called an involuntary association of insurance companies. What makes it involuntary? The legislature is making insurance companies participate in the FAIR plan. Okay, so if you are an admitted licensed insurer in California, you have to participate in the FAIR plan. What does that mean? You have to take a pro rata share of the policies in the FAIR plan and be somewhat responsible for those, and it's tied to your market share. So if you have a fifth of the market share in California, you have a roughly 20% stake in the FAIR plan, as it were. So we make insurers participate. It was started in 1968 after the urban riots in Watts and in other areas, because a lot of inner city homes and businesses couldn't get insurance. So the legislature created it. I often say, I don't think the legislature would create the same recipe today. And there's a lot of good things about the recipe. So even though people want to hate on it and they call it the unfair plan and lots of things that are not good, there is something very important about the FAIR plan, because when a lot of people say, well, it doesn't seem fair that insurance companies can just skim the cream and dump the bad risks on the government. That's not the way our plan works, because there isn't a government plan. It is a involuntary forced co-op of private insurers. And that is part of the political dialogue that's going on, where the insurers they don't like it. They've never liked it.
Speaking of that, California has been recognized as kind of a leader with insurance regulation and price management. And there's a lot of speculation that it's legitimate number of crises and large settlements that have gone on in the last few years, but that the insurance industry was anxious to chip away at California's clout in the insurance world, and that because what California does, other states follow suit. How much of that do you think is true? Is that just speculation?
Well, yeah, I think well, for one thing, the voters enacted Prop 103, back in 1988. Insurance companies have never liked it. They don't like being told what to do, period, right? It's a theoretical thing. But also because it does take them longer to get rate increases approved in California. And in fact, if you look at home insurance rates in California in comparison to the rest of the country, we are on the lower side. And we know that there's something a little weird about that, because nothing is cheaper, in California than anywhere, right? It's not really a low cost type of a state. So I think in some ways, Prop 103 has definitely kept our rates down. Insurers would say artificially low. As a consumer advocate, I would say, of course, we like our rates to be affordable, and it was fine before, and I don't understand why it's not fine now, right? It's so there's been wildfires, forever, and we went a really long time without, we went after the big spate. We had a number of years that were good. So how come we don't get a credit for that? We only hear about the bad. So I think that as always, Maureen, with any kind of a public crisis like this, it's much more complicated than you'd like to say. It'd be great if we could just say, oh, it's just this, and if we fix that, it'll all be good. Unfortunately, it's pretty complicated. Because it is true that our Department of Insurance did not approve any auto rate increase requests for 2 years. They didn't rule on them. They sat there. And insurance companies, this was during COVID, they had a lot of people took early retirement, people went remote, and the insurers built up a really big head of anger and steam. And I think they kind of said, you know what? That's it. We've been living with Prop 103, and they believe their rates have been artificially suppressed. I'm not going to opine on that. I have a lot of respect for the Department of Insurance and their rate review process. And I think, we are in a very delicate time right now, because the commissioner has advanced a strategy that the insurers seem pretty enthusiastic about, which of course makes us nervous, if they like it. But at the end of the day, it's really the only strategy that anyone is advancing, separate from let's do as much mitigation as we can, which is an agenda our organization is advancing. And let's make sure insurance companies factor in those mitigations and give you the proper credit. And let's make sure that they're not rejecting risks that are better than they think they are. And let's, get those properties out of the FAIR plan.
Can you explain what you meant by mitigations? just make sure that we're using the same language.
Yeah, so we're talking about two things: home hardening and the creation of defensible space. So making it less likely that your home's going to burn, which includes screening your vents so embers can't come in, dual pane windows, having a Class A roof, not shingled, not wood shingled, having there be 6 inches of space between the ground and any siding, having metal gates that attach, if you have a fence, not having wood fences touching your home, and then the surroundings, which is limbing trees so that you don't have branches touching the house, and what fire experts want everybody to do, which is extremely very, very painful, which is to have no plants 5 feet around your house, like nothing, no bushes, no trees, no plants, which is proving to be a really, really big challenge.
Okay, let's go back to the California Fair Plan. Let's say I'm a consumer. This is not my case right now, fortunately, knock on wood. Somebody here in Sea Ranch lives up in the hillside of the forest, particularly. There's a lot of trees, a lot of potentially combustible vegetation. Let's say the person has exhausted trying to get renewed or find a new policy, and they heard about the FAIR Plan. What is the next step, and what does the FAIR Plan cover and not cover that, quote, regular insurance policies typically cover?
So let's start with the second part first. So the FAIR Plan covers fire, wildfire, smoke. It does not cover water, theft, liability. You can buy theft, amount of theft. So that's the big one. No water. So, heavy rain, sewer backup, no coverage. Okay, but it does cover fire. So that's one. The first mitigation, so the insurance commissioner as office and United Policyholders have been working with a lot of other stakeholders, CAL FIRE and Fire Safe Councils, and communities like yours, where people have rolled up their sleeves and said, okay, we get it, we have some risk, we're going to do what we can to reduce that risk. We've been doing everything we can to speed up the pace of people being able to make these home improvements. But it's so important that people get rewarded for that, right? It's these things are expensive, and people deserve to be rewarded, because if an insurance company is charging you the same price, that they were charging you before you made these improvements, they're definitely overcharging you, right? Because the risk is reduced, that means they should be charging you less. So we're really trying hard to get those mitigation discounts in place so that people can be sure that the money and time they put in to risk reduction is going to pay off for them, as it should. So the first mitigation discounts that have been approved, because the commissioner did mandate this. He said, okay, insurance companies, you've got to give people a break here when they do this work. So there's a lot of bureaucratic mess still going on with, they all had to file new plans and then they're being reviewed. But the commissioner's office prioritized approving up to 15% discounts with the FAIR Plan for the home hardening and the defensible space. So improve your structure, improve your surroundings. But as with everything, there's paperwork, there's delays, I submitted my paperwork, I haven't gotten my discount. When am I going to get my discount? These are all kind of, I would have to say, works in progress. So the bones are there. You can get up to a 15% discount on your FAIR Plan premium. But it's just, getting to the right person at the FAIR Plan to say, okay, here's your discount, and then seeing that premium reduced. Those are the parts that I think, we haven't seen as much success stories yet as we want to see, but it's coming.
So what doesn't the FAIR Plan policy include that a normal policy would include? I've heard, for instance, liability is one of the things.
It does not include liability. So if somebody sues you and you're insured with a FAIR Plan, you don't have that policy to give you a lawyer, to give you a defense. And That's a
So
big.
you have to then go, consumer would then have to go buy a separate liability policy?
So if you have significant assets, you're going to want to buy a supplement to the FAIR plan. You're going to want to buy what's called a DIC. It stands for difference in conditions, and that will plug some of the holes in the FAIR plan policy. So the liability, the water, the wind, right?
Okay.
Coverage wise, you will find, because of the FAIR plan prices being higher, because it's a higher risk pool, you will see households having to buy less coverage than they really need, just to keep that premium affordable. So you will see people going with depreciated actual cash value coverage instead of replacement value coverage, because that's all they felt they could afford. You will see people buying a smaller level of contents coverage. Also, you will see people buying just the depreciated value sort of their stuff. The temporary rent coverage is a little different. Instead of with a normal policy, you have either a set dollar amount and 3 years to use it, or you have a monthly allocation of your temporary rent. With a FAIR plan, it's the fair rental value of your place, what you would have been able to rent it for, which is very different from what it with a normal policy. Like it's to maintain your standard of living. Like if you have 3-bedroom, the insurance company has to pay for a 3-bedroom, right? With the FAIR plan policy, it's different.
Yeah, just to clarify for our audience too, is that what Amy's referring to is a feature in insurance policies where if you do suffer a devastating loss and you're either completely wiped out or you completely can't get back into your home, you get to live somewhere else and have, that's what she's referring to. You get the rent in when the fire occurred for us. We had some options, but basically it's the cost of what you would have had in your normal life, the kind of the quality, the size, et cetera. And now they're kind of chipping away at that in terms of what Amy just referred to. But it's a feature of insurance policies. Let me go back to what you said a moment ago about what's going on in Sacramento. That makes you a little bit nervous about what Commissioner Lara is working on with the insurance industry. Tell us more about that. And because one of my big questions beyond this is what's next in terms of legislation, coverage, regulations, whatever. But what exactly were you alluding to? What's going on there?
The strategy, the sustainable insurance strategy, which is what the commissioner calls his plan, is really aimed at restoring availability. And affordability is a little bit being pushed down the road. So the idea is, let's get insurers back in the market, and then we will focus again on what to do about rates. Right now, they are sort of focusing on trying to bring rates back, down to earth with the mitigation discounts. Right, they are priority. I mean, the commissioner has definitely been very good on. We're going to make them give you a discount and make sure that the rate is adjusted accordingly. But the strategy is really aimed at restoring insurers' confidence in doing business in California. There are other people that are looking at some sort of more strategies that are sort of longer term. So, for example, Adam Schiff, Congressman Schiff is advancing a proposal that would create a national insurance, disaster insurance pool with a reinsurance facility and mitigation incentives. Congressman Thompson is advancing a bill that would give every household $10,000 grant access for mitigation steps. Also some tax advantages, that a risk reduction grant, you wouldn't have to pay taxes on it, and or that your expenditures on mitigation could be tax deductible. So there are those sort of longer term solutions that are looking to restore affordability. I think the commissioner is just trying to get insurers to take their finger off the pause button, and thinking if we could do that, it'll be easier to talk about how do we get affordability back. But of course, that makes me nervous as a consumer advocate.
Yeah, we'll get back to you on that pricing stuff. Yeah, right. Okay, so is there anything else that, I mean, California, we obviously we live in California and we've experienced these fires and other disasters firsthand. Have we learned anything? But we're certainly not the only state, whether it's through climate change or other reasons, that is going through these types of crises. Is there anything California can learn from other states in terms of dealing with these same challenges?
I mean, I think, enforcing your building codes, being, I mean, we have a, preventing development in areas that are high risk, or is a tough one, right? Because we have this housing crunch, we need more affordable housing, and, so sort of you got these conflicting priorities, right? We want there to be more housing. It's really expensive to build in urban areas, so that, developers are looking to push out into, the woo-wee in the wild and urban interface areas. And I think, there's a lot of people saying that that's not a good idea. I think that, we've learned, what have we learned? This Alabama had a really similar kind of crisis in their insurance market, and they really beefed up their fortified home program of, like, roof tie downs. And it's a lot easier to reduce hurricane risk than it is to reduce wildfire risk. Wildfire risk is tough because we're talking about all these vulnerabilities in the individual home, but also in a community, right? You do everything right, and your neighbor's like, harumph, I'm not, you don't tell me, or whatever, or I don't have the money, or I don't know what to do. And then, that's a problem for you because, insurance companies are saying it's not enough for an individual household to harden and do these things, because if their neighbor doesn't do anything, their house is still going to burn. And that's the sad thing that we're seeing in Paradise is, we have a volunteer who lost his home in the campfire and just lost his home again.
Yeah.
And he rebuilt resilient just like you did.
Yeah. As we're kind of coming towards the end of the hour, and I wanted to just maybe have you summarize what anybody listening could do. I found the United Policyholders website to be an incredible resource for the fortifying, home hardening, whatever you want to call it. Why don't you give us an overview of what a consumer could find there if they're still sitting there wringing their hands because they've gotten turned down and they're facing up with having to have the FAIR plan and pay a lot more. Where should they start with your website?
So there's a navigation bar, and when you go to get prepared, there's a little drop down menu. Go to drop by your insurer, click on California, and that will take you to some bullet points, but then also a slide deck. We've been doing shopping help webinars now, like twice a year, and then in between we do a lot of town hall presentations. And so we keep on refining our slide decks. So just to boil it down, it's not anyone's favorite topic. So we try to kind of just hit the highlights. So you can go there and look at one of those slide decks, and it'll really boil it down. And also, I made one of these slide decks for your community. And, if you have I don't know if you have you must have like a bulletin board, digital bulletin board. You're welcome to publish it there for folks.
Thank you. Thank you, Amy. George, do you have any other questions for Amy?
Yeah, I wonder, this is just a simple one as we maybe draw to a close here. Amy, could you just summarize the main points that you've made here? We've got this insurance crisis. The insurance industry is going through a number of changes. The state insurance commissioner in California has a plan, and your organization has provided a lot of strategies and tactics and what and how you can work. Is that a good summary of kind of what where we're at today?
Yeah, I think that the reinsurance sector, those are the real puppet masters here. Those are the companies that take on the really high dollar catastrophic risk, right? Now that disasters have been hitting them in their pocketbook, they are now saying to their insurance company clients, they're being a lot more directive. We do not want to see houses in your book of business that have a risk score of X, right? So there are some factors we can't control. So I think we have to focus on the ones we can control, right? We can control our own homes as best we can. We can look for grants, information, who can help me with hardening my home. We can participate in community programming. But at the end of the day, we're probably going to need some sort of a federal program, because the reinsurers, their decisions, their pricing is not really regulated. So a lot of what's happening now is because they're up there going, whoa, and that's really causing a ripple effect down the chain.
Yeah.
I just have one more question. You made me think of one. If, let's say I got I've not been renewed or something, and I find out I have a quote score that I've been given. My property's been given by the insurance agency. And yet I think I've done everything I can to do the home hardening and defensible space and everything else. What recourse do I have?
Well, that's right
How do I
now.
even find out what my score is?
Right. Well, so that is another good thing the commissioner did. He did put a regulation that requires the insurance company to tell you what your risk score is and then provide you with an appeal process. Now, that doesn't mean that they have to do anything about it. If you say, well, I can improve my score, well, that's nice. I think the next step is going to have to be a bill that State Senator McGuire is carrying, that says they got to tell you what the problem is with your house, how you don't meet their requirements, give you enough time to address the problem, make the repairs, and then when you prove to them that you did it, they need to renew your policy. Now, that's not law, and in fact,
I say that would be huge.
And he's one of the more powerful people. He's the Senate Pro Tem Majority Leader, and even he can't get a hearing for that bill. So we are a ways away from forcing insurance companies to insure people they don't want as customers. But I want to remind you that that's what the FAIR Plan is. The FAIR Plan on a small scale is forcing insurance companies to take some risks that they otherwise don't want. So we actually have a decent structure in place. It just needs a little fine tuning here and there. And we could be on a healthier trajectory going forward.
Great. Well, on that note.
Yeah, thank you so much, Amy and Maureen. Great questions, of course, coming from a wildfire survivor. I'd expect we like that. Amy, thanks. You've provided a lot of information for our audience. You've provided the slide deck, which we'll make available to the community up here, and we'll direct people to your website, uphelp.org, so people can get, if they're losing their homeowners or they're looking at ways they can harden their home or any number of other issues, they can get information there. Thanks so much, Amy. We appreciate your time and the wealth of information that you've given us. Thanks so much.
It's my pleasure to be with you, George and Maureen, today, and here's to some relief in the future, because we want to stay living in these beautiful places like Sea Ranch.
Well, thank you, Amy. I can't thank you enough for being the co-founder of United Policyholders, and the good that you and your organization have done for so many people is almost incalculable. So thank you.
Well, thank you for giving some of your time to help with our governance and stewardship.